In Chapter 16, which is our final chapter in this class, we're going to look at control systems and quality management. Control is what you as a manager do to get things done, with controlling shown in relation to the three other management functions that we have discussed. Keep in mind, these are not lockstep. All four functions happen concurrently. In controlling, you are monitoring the performance, comparing it with your goals, and taking corrective action as needed. Control is needed to adapt to change and uncertainty, to discover irregularities and errors, to reduce cost, increase productivity, or add value, to detect opportunities, to deal with complexity, and to decentralize decision-making and facilitate teamwork. Figure 16.3 shows the steps in the control process. The first is to establish standards. The second is to measure performance. The third is to compare performance to standards. And the fourth is to take corrective action if necessary. An example may be if I set a goal to run 1 million bars in 24 hours, I have established my standard. I would then run 24 hours worth of production, measure my performance. I would then compare the performance to the standard. So let's say I only ran 750,000 bars instead of the 1 million. I would move on to step 4 where corrective action is needed. With corrective action, you have to decide if your standard is wrong or if it's a performance issue. If the standard is wrong, you need to correct the standard, and if it's a performance issue, you need to correct the performance. There are different levels of control. There is strategic control, tactical control, and operational control. With strategic control, you monitor the performance to ensure that the strategic plans are being implemented and you take corrective action as needed. With tactical control, you monitor the performance to ensure that tactical plans, those at the divisional or departmental level that we talked about previously, are being implemented. And with operational control, you're monitoring performance to ensure that operational plans, those are the day-to-day goals, are being implemented and then taking corrective action as needed. The balanced scorecard gives managers a fast but comprehensive view of the organization via 4 indicators. One is customer satisfaction, the second one is internal processes, the third is innovation and improvement activities, and the fourth is financial measures. We will talk about each of these in the next few slides. The financial perspective looks at profitability, growth, and shareholder value. The customer perspective looks at the priority of taking care of the customer. Internal business is exactly what it sounds like, where you are internal focused and looking at areas such as quality, employee skills, and productivity. And then finally, innovation and learning deals with the growth of your employees. A strategy map is the visual representation of the 4 perspectives of the balanced scorecard that enables managers to communicate their goals so that everyone in the company can understand how their jobs are linked to the overall objectives of the organization. This is important because it increases buy-in from every employee regardless of their function or their job within the organization. Figure 16.6 shows an example of a strategy map and how it covers those 4 areas that we just talked about. Budgets help with the formal financial projections. Incremental budgeting allocates increased or decreased funds to a department by using the last budget period as a reference point. Only incremental changes in the budget request are reviewed. I think of this somewhat as my personal budget as well. I can make a comparison between the two. For example, I might carry over most of my budget from November to December, but I know I have to make an incremental change in the fact that Christmas will be in December, and that may affect my budget. This slide shows table 16.1, which addresses the different types of budgets. You guys should take a minute and become familiar with the different types of budgets that are present on this slide. It's also important to understand fixed versus variable budgets. Fixed budgets allocates resources on the basis of a single estimate of cost. For example, a fixed mortgage, would be an example of a fixed budget line item that a company would have. Variable budgets allows the allocation of resources to vary in proportion with various levels of activity. For example, your payroll budget may be a variable budget if you are in a company that has a lot of overtime that it needs to pay. Some important financial statements that you will look at in your accounting and finance classes include the balance sheet, which summarizes an organization's overall financial worth, assets, and liabilities at a specific point in time. That is important. It is a fixed point in time for the balance sheet. For the income statement, this summarizes an organization's financial results, revenues, and their expenses over a specific period of time. Ratio analysis is important when looking at the financial aspects of a company. There are many of them, but for this class I want you to know these three. Liquidity ratios indicates how easily a firm's assets can be converted to cash. So for example, how quickly could you sell your equipment if needed in order to raise cash for your company? Debt management ratios look at the degree to which a firm can meet its long-term financial obligations. And then the return ratios, how effective is management in generating a return or a profit? Audits are formal verification of an organization's financial and operational systems. There can be both external and internal audits. Internal audits are performed by an organization's own professional staff, and an external audit is performed by outside experts. When I was in industry, I was an ISO auditor for my company, an internal auditor for my company. I would periodically go around to other groups and assess how they were with their ISO standards and whether they were following them. And then once a year or once every 3 years, depending on our audit cycle, we would have external ISO auditors come in and perform audits as well. Figure 16.7 shows the PDCA cycle, which is plan, do, check, and act. You see this a lot in businesses in different areas. The plan of step 1, plan, is looking at important changes based on observed data, and if necessary, do a pilot test. Step number 2 is the do. This is when you implement a change or make a small scale test. 3 is check, or observe what happened after the change or during the test. And then finally, act. This is where you act on lessons learned after study of results. You determine if predictions can be made as a basis for new methods. Total quality management is a comprehensive approach led by top managers and supported throughout the organization, dedicated to continuous quality improvement, training, and customer satisfaction. The key to understand about total quality management is that it says that quality is everybody's responsibility. It does not mean that you're only concerned with quality if you work in the quality department. It states that quality touches everybody and everybody is responsible for it. The last slide of this chapter, as well as the last slide for this course, deals with managing for productivity. Productivity is measuring the output in comparison to the inputs. Outputs are the goods and services produced, and inputs are labor, capital, materials, and energy. This shows the formulas for calculating productivity. Again, you will see this in later classes, but it is definitely a part of the control cycle. If you do not pay attention to the quality of your productivity, it can also hurt your company and the bottom line. Please let me know if you have any questions, and congratulations on finishing the last chapter in BUA 301.